Hello everyone, welcome to Investing for Beginners. Thank you subscribers for tuning in again today. Today we're going to be talking about what a bond is. Now a bond is a loan given to a company or government paid by an investor in which the investor receives a small percentage of interest each year on the initial principal amount. Now in this video today we're going to be talking about different kinds of bonds, how to determine different risk levels of bonds and how that correlates to different coupon rates. And we're also going to be going online to take a look at best ways to buy a bond and ways to identify which bond is perfect for you. Now, just to give you an example of a bond, we're going to be looking at Alpine City, which is trying to generate $70,000 for a park that they are trying to build. The city issues 35 bonds at a price of $2,000 per bond. Here are 35 bonds. Each bond has a coupon rate of 5%. Now, a coupon rate is the same thing as basically the ROI. So each year, the Alpine City will be paying 5% of the initial principal amount, which in this case, that 5% is going to be equivalent to $100 each year, since it'll be 5% times the principal of $2,000. And the bond's yield to maturity, or time that it takes for the bond to be fully ready to be cashed in without any penalties, is 10 years. Now, just to give a better breakdown of how the math of this works, so the firm, or the city in this case, will be paying the investor $100 each and every year on the principal amount. And then on the 10th year, when the bond is fully reached its maturity, the investor will receive the $100 from the interest and will also receive the principal of $2,000 back. So the $2,000 that the investor invested into the city after 10 years will be worth $3,000. Now we're going to be talking about some important things to know about a bond. Bonds are much more predictable in many cases than general stocks or the stock market. Bonds are not nearly as volatile like a stock, so if you're a little bit weary or nervous about getting invested in the stock market and you're afraid you're going to lose everything, a bond is a much safer way to go, but yet still grow your money. Bonds are given a risk rating where AAA is the least risky and AA is a little bit more risky, A is a little bit more risky than that, then BB, and so forth and so on, which is just a little way to help identify a bond's risk level. And typically, as the risk decreases, the coupon rate also decreases. The coupon rate is usually there to give an incentive for taking on riskier bonds. Now, bonds are also considered to be debt, which is very important because stocks are not considered to be debt. So if a company goes bankrupt, bondholders are paid before stockholders, which means that you are more likely to get your money back if you are a bondholder in the case of a company going bankrupt. Also, bond coupon rates increase as the yield to maturity increases. This is just because as the yield to maturity increases, there is an inherent greater risk that is associated with that longer period of time. More bad things can happen to the company, and for this reason, the company or the government will give that little extra percentage as a thank you, basically, for taking on that extra risk. Now we're going to go take a look at some actual bonds online, and we're going to look and see which bonds are best for you. Okay, so today we're just going to be using Fidelity to look at different bonds. However, there are many other different companies that you can look at online to find different bonds. So on Fidelity's website, all you have to do is up here at the top, you want to go to News and Research, and we're looking for bonds. So you can go to Fixed Income, Bonds, and CDs. Click on that, and it'll bring you right here to this Fixed Income, Bonds, and CDs page. Now, if you scroll down, it'll show a big list of several different bonds and the percentages they pay over different yields to maturity. So like we were talking about earlier, AAA bond being the least risky, as you can see, pays a smaller coupon rate than, for example, the BB bond, which is a little bit, or the triple B bond, which is a little bit more risky. Also, you can see that in general, the coupon rate increases as time increases. Again, this is just because it's inherently more risky to take on a longer yield to maturity for a bond. So let's just say that you wanted to buy this AAA corporate bond at 10 years. You could just click on the percentage, and then here it'll give you a little bit more details. It'll give you two different ratings from the most reputable rating sources for bonds, and then here you could buy or sell the bond. And yeah, that's pretty much all there is to it. If you have any more questions about bonds, please list that below in the comments below, and I'll try to get those answered in a future video. And please like and subscribe and tune in next time. Thanks.